Hello, everyone. Thank you for joining us today, and welcome to this specialist trading educational presentation, where today I want to talk to you about 4 steps to trading consistency. You're going to see how simple it is to apply this to any method you're currently trading. Doesn't matter what market, doesn't matter what time frame, but I really think if you apply these 4 steps to whatever style or whatever market you're trading, you really increase your odds for consistency. For example, let's take a look at this chart right here. Here's an older chart in Adobe, all right? Someone looking at this would say, well, don't really have any idea what the trend is, but maybe we're in a downtrend because we're going lower, okay? For all intents and purposes, it looks as if you're going lower. You made a lower low there and you're just kind of bouncing. But the first step I'm going to reveal to you actually would have said, no, we're not in a downtrend. It would have told you very succinctly that we are in an uptrend. And then with the second step, you could have decided that you wanted to actually buy right here. The third step would have identified where to place your stop. And ultimately, the fourth step would have told you to exit right here for a profit. And you'll see that all of those things actually did come true and happen. So with these 4 simple steps I'm going to be revealing today, you'll really increase your odds for trading consistency. And everything you're seeing today is easily applied using the PTS Primo charting platform. This is an educational platform I developed and designed with Pro Trader Strategies that actually teaches you how to trade. Welcome once again. My name is Stephen Primo. I am the president and founder of Specialist Trading. I've been trading now for 47 years. I started my career on the floor of the Pacific Stock Exchange. I was a specialist on the floor. That's someone who makes markets. So I was a specialist making markets in roughly about 50 or 60 stocks. I made markets during the crash of 1987 and the bull market that followed. I left the floor in the mid 1990s and I started to manage money, trade my own account and manage money. And roughly about 15 years ago, I began teaching. I teamed up with Pro Trader Strategies with one goal in mind. That was simply to educate traders. That's really what it's all about. If you have proper education, you will increase your odds for consistency. Now, most traders think, well, yeah, Steve, I go to that blog, I read that blog, I go to that trading room, I listen to that guy on TV, and that's proper education. Well, not really, because they're all designed to take you out of the game so that you can just blindly follow them and do what they do. That's not the education I'm talking about. Education simply means, sure, having mentors, listening to what people say in trading rooms or blogs, but not becoming attached to them, using that information so that you can ultimately make your own trading decision. You see, that previous way is designed for you simply to follow blindly and mimic whatever they're doing. But it's been my observation in the last 47 years that the only traders that really are consistent, the one that hang around for not just a couple of few years, but a couple of decades, are the ones that make their own trading decisions. They don't listen to people on TV. They don't wait for earnings. They have a plan in place that they put together through education, and then they simply follow it. So that's what we're devoted to, giving you ideas, plans, things that have stood the test of time in terms of high levels of consistency so that ultimately you can make your own trading decisions. In my opinion, that's the only way you'll become a consistent trader. And you'll see that attention to detail in today's educational class. Now, before we begin, we are required to share this with you, so please take a moment to view our disclaimer. I'm going to show you a lot of performance results using these 4 steps, but please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated. Also, please remember, since we are first and foremost an educational company, all examples are strictly for educational purposes only. Now, if you haven't followed us on Twitter, please do so now, if Twitter or X, whatever you want to call it, previously known as Twitter, because there is a lot of free education on a daily basis. I post upwards of 4 to 6 different postings a day, signals our strategies and methods have generated, and also bits of financial wisdom. So lots of great free education on a daily basis. Please feel free to follow us on Twitter or X. And remember, we are a little bit different from other webinars you may have attended. I know a lot of you have gone to webinars and the guy tells you in that class, or the woman says, well, this is what you should buy and this is what you should sell. This is what you should stay away from. This is the perfect market time frame. This is the perfect platform to be using. You know, everyone has a different idea, but the thing that separates us from them is that we never predict or tell our students anything, because once again, that goes against our philosophy. Our job as a mentor is to teach you how to trade, not to trade for you. Therefore, at Specialist Trading, you won't find any chat rooms. You won't find any nightly signal service. We're not telling you how to trade. We're trying to teach you because, once again, our whole philosophy revolves around the fact that you have to decide. Remember, all the good traders that I have ever known in my 47 years of trading made their own trading decisions. They didn't rely on someone or something else to tell them what to buy or what to sell. And that's the information we're trying to instill in you as well. Okay. Now I have a great educational presentation for you today, but a few things before we start. This is being recorded, so if you have to leave early or if you're having technical issues, oftentimes if you just log off and then log back on again, your internet connection is what's causing that problem. But if you're still having technical issues, don't worry. Each and every one of you will get a link to this recording where you can watch it at your own leisure. Also, I do want to take questions. We have a good crowd here today, but if we stop for every slide, we'll be here far too long on a Wednesday, so I don't want to take all of your day up. So please, if you have a question, kindly wait till the very end to ask them, okay? Many times, your question is often asked on the very next, answered, I should say, on the very next slide. So if you do have a question, please wait till the very end, okay? All right, with those two things out of the way, let's begin our educational presentation. Now, I want to start off with something my mentors said to me when I was struggling some 47 years ago on the trading floor. They said, Steve, trading is really simple. It's the trader who makes it more difficult than it has to be. And the reason why they said this to me is because if you could have seen my trading setup on the floor years ago, you would have known why, because I had roughly about 4 monitors I was looking at with tons of stocks and tons of indicators, probably about 60 or 70 indicators blasted on there. I was listening to all the news that was coming over on the television on the floor. We didn't have any chat rooms at that time in the 70s, but we had newsletters. I subscribed to all the different gurus telling me what they thought the market was going to do or the best stock or market to buy or sell. So I was waiting, for all these announcements to come out, such as jobless claims or earnings reports. I was doing all the things I've been taught to do. And guess what? I couldn't make a dime. I was barely trading water. And my mentors were specialists who had been trading roughly themselves around 30 or 40 years each. And they saw how difficult a time I was having and how much I was struggling. And they said, listen, trading is really simple, but it's you who's making it more difficult than it has to be. So once I really learned how to strip away all these things that really don't have a lot of levels of consistency, like news or indicators that you don't have any idea what they're based off. Many of these things are just too subjective. When you just started looking at things that were cut and dry, that's when my trading started to become consistent. So this is the theme of today, keeping things as simple as possible. Now, in order to be consistent, you must always ask yourself these 4 questions. These are the 4 steps you must ask in the form of a question. So let's go through them. All right. And remember, you don't have to write these down because this is being recorded and you'll get this and you can watch it as often as you like on a recording. Okay. Question number 1. Before you pull the trigger, before you're even in the trade, in fact, this is required before you're even in the trade, ask yourself, am I on the right side of the market? Now, I'm sure that you think you're on the right side of the market. I'm sure that you have a certainty that you've studied and you know that you're in sync. But think of it. Whenever you're not on the right side of the market, that's when you lose. Now, if you've had a string of losses, the market is telling you you're not on the right side. You're not going along with what I want to do. So obviously, when you're buying and the market goes down, you're not on the right side. And if you're selling and the market goes up, you're not on the right side. So this is extremely important. The first thing you have to ask yourself is, am I on the right side of the market? Now, looking once again at this older chart of Adobe, all right, someone would say, okay, well, not really sure because the market's going up, going down, going back up, but it's simple. The first thing we do is apply the 50-period simple moving average. That's how we find out if we're on the right side of the market. So it doesn't matter what time frame, doesn't matter what market you trade, you should always have a 50-period simple moving average on your chart, always. That's the first thing we teach our students around the world. And once you have that plotted, then you ask yourself this question: where is price in relation to the 50-period simple moving average? In fact, that question is so important. I always recommend putting it down on a little Post-it and putting it on your computer screen, because so many students forget to ask themselves that question. But you have to remember to ask, where is price in relation to the 50 simple moving average? And as you can see here, the majority of price is above. Now, if price were below, that would mean the overall trend is down, and that would mean we're not a buyer, we're looking to sell or go short. But in this case, price is above. So that's telling us the overall trend is up. Therefore, we should only be looking for buying opportunities. You will have a higher level of consistency if you only look for buy opportunities when price is above the 50-period moving average. Okay? All right, so you say to yourself, okay, so I thought we were in a downtrend, but I guess we're not. I took that candlestick course, and guess what I see here? A bullish engulfing pattern. Okay, so Steve says I should look for buy setups. All right, well, this is a buy setup, a bullish engulfing pattern. Now, I just want to be conservative, so I'm not going to buy at the market. I will buy if we trade, one or two ticks above there. Okay, that's a nice plan to have, which leads us to the next step, which is question number 2. Where do I place my initial stop? Now, most students, especially beginning students, say, well, why do I have to worry about my stop? Shouldn't I first ask, where am I going to get out with a profit? No, that's not actually important at all. The first thing you should ask yourself is, what if I'm wrong? Where do I get out? You see, how many times you've been in a trade and you say to yourself, wow, it's not working well. I'll just hold on a little bit longer. And then it goes lower and you say, wow, okay, well, I'll buy some more and I'll just kind of wait for it to go back up and then I'll break even and get out. But then it just keeps getting worse and worse, right? We've all gone through this at one time or another. So you have to know in advance where you're going to get out completely if the trade is wrong. This is where we place our stop. Now, on our courses, we have upwards of 6 or 7 different ways to apply your stop. We have high risk stops, low risk stops, very standard stops. So it's up to you to decide. Remember, our job as a mentor is to provide you with these things so that you can make your decision. Let's just use one very generic place to apply your stop, okay? All right, so we know that we want to buy once we trade one tick above here. Now, the most generic way to place your stop is to go backwards, and find out where the nearest short-term low was. Now, the way you do that is by looking at the pivot low. That means you have a low, it's a 3-bar pattern, a low followed by a lower low, and a higher low. So this creates some type of a V shape, right? That's most likely telling you that if price goes below that area, most likely all bets are off and we're going to head lower. So that's a good place, a generic place to place your stop. Okay? So now this leads us to question number 3. Step 3 is, now we can ask, what is my profit target? Now, there are different ways to determine a profit. One is to have a profit target that is kind of nebulous, which is kind of just a non-defined profit target where you're just letting the market take you out or deciding with some discretion, okay? The profit target we're going to use in this particular example is a more defined, it's called a fixed profit target, all right? And once again, in our strategies, we have upwards of 6 or 7 different ways to exit. This is just one of them. Okay, so we're going to use a fixed exit. So how do we determine this? Well, this is why we determined the stop placement first, because if we entered here at this level, and if we exited here with a loss, how many points would we be risking? Well, that turns out to 11.25 points. Now remember, we haven't gotten into the trade yet. So we have to ask ourselves, regardless of how many shares we're trading, can I afford to risk that many? All right, if I trade maybe 200 shares, that's too much. I'm risking too much. But if I maybe trade 50 shares, okay, I can risk that. So this is a good way in helping you determine how much you should expose yourself, your capital. So say you tell yourself, okay, 11.25 points I can do with, say, 100 shares. All right, that's fine. Okay, so that's your risk, 11.25 points. So what you want to do is be able to make at least twice that amount. This is called a good risk-reward ratio. So the most initial place is that you want to make twice what you risk. So if we're risking 11.25 points, we want to make at least twice that amount. So what we'll do is we'll double that. 11.25, we'll double that from where we enter, and that comes out to 22.5 points. And this tells us exactly where our exit is, which would come out to 247. So now we know where our entry is, we know where our stop placement is if we're going to be wrong, and we know where our exit is. And we haven't even got into the trade yet, okay? Which brings us to the 4th and final step in the form of this question, which is, how do I protect my profit? Now, we've all been in this scenario before. We've had a great trade going. We feel very good about ourselves. We go, wow, this is going to be great. I'm going to have a good month. I'm going to make a lot of money. And then you go to bed and you wake up the next day and some news comes out and the market starts to head lower. And now that nice profit you have is now unchanged. And then a day later, now it's a loss. And you're saying to yourself, wow, I felt really great about myself just a day or two ago. Now this is terrible. Okay. So you want to be able to protect that profit. How do we do that? Well, we do this by applying what we call our 50% rule. What that means is if you entered it here at this point, and this is where you want your exit to be, when you get at or near the 50% level, the halfway mark, you want to move your stop to unchanged. Okay. This way, if things, are looking great at this point, and all of a sudden they roll over, you don't want this nice profit that's taken you a week or so to accumulate into a loss. So let's watch this trade unfold. As we see here, we're not long yet. And right here, we got long because it traded right above that bullish engulfing pattern. So we're in the trade. We're just watching it. It's going in our direction. This is where we're all excited, thinking we're going to make a lot of money, but we don't know yet. But guess what? On this day right here, we got to that level. So all we want to do now is move our stop to where we entered. This is called moving your stop to the entry price or unchanged. Why is this so important? Because now if things turn sour, if all of a sudden this turns around, we're not going to lose anything. We all know that the worst feeling in the world is to have a profit on paper and then have that paper profit turn into an actual loss. So we want to protect that. We want to protect that profit by moving our stop to the entry price. Okay. So this is commonly referred to as playing with the house money. In other words, you have nothing to risk. So let's watch and finally see that the only thing left to do is watch the trade unfold. All right. I've often said this to my students that if you are trading correctly, it's boring because you came up with all this scenario before. You knew where your entry was, you knew where to place your stop, you knew where your fixed exit was, and you just sit back and watch. There's really nothing left to do. If you're screaming and yelling, if you have 10, 20 computers in front of you, if you're waiting for news to come out, if you're, have a million things going on the way I used to trade some 47 years ago, you're really not trading correctly. That's more of a gambling mentality, okay? All right, so we just watch and wait and see what happens. We're either going to be stopped out unchanged, we're not going to lose any money, or we're going to have a nice profit. So as we watch this trade go in our direction, it kind of heads up, and now it's heading lower, but we're still watching and hoping, and ultimately it gets right to the place we want it to. And we come out with a profit of 22.5 points. Okay, you see how simple that was? I'm going to let you watch that for a second. Just hold on. I just have to pause here for a second, and then we will come right back. Okay, I am back. Sorry, I just had to fix something, a technical issue I was having, but now it's corrected. And let's look at another example. We're going to use the exact same 4 steps in the form of questions, but we're going to look at an entirely different example. All right, here's an older chart in FSLR. Now, if you're a technician, if you like to look at patterns and like to look at different movements in price, well, this is what's called a bullish wedge. All right, extremely bullish pattern. You have the base here at the bottom, and with this downward slope, what it usually says is if price breaks out above and closes above, well, most likely we're going to take off and go up to new highs. All right. So this is a very bullish pattern. You're all excited. You found this. Maybe some guy in a chat room told you about it. You're all excited, and you're waiting to see what this stock does. And so you see the very next day it closed above that downward trend. So you say to yourself, you know what? That guy said this is a great pattern. That guy on TV or in the chat room, I've got to buy it because after all, they know what they're talking about, right? They're on TV or they give some seminars, they know everything. So I'm not going to go against them. So I'll buy it. Remember, this is the way most traders trade, relying on someone or something else to tell them what to do. But why don't you use things that are consistent, that not someone on TV, not someone in a chat room, not some economic report, not even some guy in a webinar like myself, but what the market is telling you. So how do we do that? This brings us, rather than buying, we come to the first question, and that is, ask yourself, am I on the right side of the market? Before I jump into this, am I on the right side of the market? Now, how do we do that? Well, remember, we wanted to buy, but we apply the 50-period moving average. And then we have to ask ourselves, where is price in relation to the 50-period moving average? Now, originally, it was above, but then ultimately we had 1, 2, 3, 4, 5, 6, 7 closes below. That's more than enough that the market is telling us, no, it's not a good buy. The odds are this is not going to work out. I mean, sure, you may see some nice trades work out every once in a while that are below the 50-period moving average and they go up, or above the 50-period moving average and go down. But over time, it's like the slot machines in Vegas. Over time, they're really not going to help you, because just like the slot machines, they're designed to give you a winner every once in a while, give you this false sense of hope that, wow, I'm doing well. But if you stay at the slot machines over time, you're going to give all your money back. They're designed to do that. And that's the same way it is when you're out of sync with the 50-period moving average. Over time, if you buy below the 50-period moving average, sure, every once in a while you get a nice winner, but over time, you're going to give it all back. Take it from someone who knows, all right? This is the way I used to trade. So the odds are we're not going to do well with this trade, because price is telling us, not me, not some economic earnings report, but the chart in front of you is telling you, no, I want to go lower. Okay. So we decide not to buy. Say to yourself, you know what? I'm not going to buy. Take this after all. I'm going to rely on this 50-period moving average. Okay. And you say to yourself, okay, well, if I'm only supposed to look at this from a seller's point of view, I can either stay on the sidelines and avoid this stock, or maybe look to go short. Now, what do I see here? Well, I'm a technician, and guess what? It didn't go up. So thank goodness I didn't buy it. But here's a base that it's kind of building, all right? Some type of mini support. So you say to yourself, okay, I see so far it looks like it's not going to go up. If we go below this line here, I'm going to sell, all right? If we break that little support, I'm going to sell. All right, okay, that's a foolproof plan, all right? At least you're in sync with what the market's telling you, which leads us now to question number 2. Where do I place my initial stop? Remember, we have a number of different ways to place your stop. Let's just use the same generic one, which is the short-term high. So if we look back, once you see where you're going to enter, you go back in time and see where the last high was, and that was right here. Kind of created this high, a higher high, and a lower high, which displayed this kind of a arrow approach. So this is the last short-term high, and this is where you would place your stop if you decided to take the trade. Remember, we're doing this all in advance of even entering the trade. Question number 3. Now we can ask, where's my profit target? We have a number of ways to determine where to get out with a profit. Let's just use the fixed exit. And the way we do that is we ask ourselves, well, if we got short roughly around right here, and it didn't work out, and it went right up, and we got stopped out with a loss, how many points would I lose? And the answer is 8.20 points. That's how many points you would lose if the trade did not work out. If you can afford to lose 8.20 points, if that's okay with your capital, then you say, okay, I'll take that trade. Now, what you want to do is double that. In other words, if you're risking 8.20, you want to make twice that. Have a good risk-reward ratio of 2 to 1. You'll make twice what you risked. So if we're risking 8.20, we want to make twice that, which is 16.40. And since we're shorting, what we want to do is subtract it from this level. So we subtract 1640, and this gives us our fixed exit at 51.15. So you can place all these orders in before you even trade. You can place where you're going to get short, you can place where your stop is, you can place where your entry is, and you'll just sit back and wait. Remember, trading is really boring. You just sit back, you plan it out, put the rules in, place the orders, and then sit back. Once again, question number 4 is probably the most important, because once you're in the trade, how do you protect your profits? Well, once we're sitting back and watching the trade, we know that if we get at or close to this 50% level, half the distance from our entry to our exit, we want to move our stop from here to unchanged. Okay. Now, this is not, a lot of my beginning students say, well, Steve, so do I have to wait for it to trade exactly there? No, this is more discretionary. Even if it got down to, let's say, here, and you had a feeling that the market was starting to, turn upwards, you can move your stop here. It's very close to that level. So this is not written in stone that it has to be at this exact number. Let's watch the trade unfold. All right, so you're short 1, 2, 3 days. It obviously got there to the 50% level. So now you do not want to keep your stop here, because if something happened and this turned around, you had a really nice profit turn into a really big loss. So what you want to do is move your stop to the entry price. You're not risking anything if price decides to go back up. Now, the only thing left to do is watch the trade unfold. It's like fishing. It's like sitting in a rowboat. You throw out your cast your line and you just throw it out and you just sit and wait. That's the way trading is. Trading is not yelling and screaming, having 20 million trades at once. It's not having a million monitors. It's just very boring. It's just sitting back and watching. All right, so let's watch the trade unfold. We're now short, and look at this. Wow, it's really going in our direction. And in 4 or 5 days, it gets there. So we made a profit of 16.40 just based on very simple premises. These are the 4 steps that you can apply to any method, to any trading technique, to any trading system, to any trading strategy, and will really increase your odds for consistency. Now, here's the good news. Each and every one of these 4 steps that I just taught you are included in one of our most consistent methods. This is strategy number 4. This is a full rule-based strategy that we teach our students. It's one of our most popular as well as consistent methods. This was the first method that my mentors taught me some 4 decades ago on the floor. And guess what? I still use it today. In fact, I had 2 trades today, intraday trading the E-mini, that were both profitable using strategy 4 on an intraday trade. Let me tell you a little bit about the highlights. It's a pattern recognition strategy. So it looks and identifies a pattern that reoccurs over and over again in any market and in any time frame. It's designed for traders looking to catch momentum. But the good news is, many times you think of momentum, you think of a stock or a market, a currency pair or a crypto, it's taking off and there the momentum is already obvious and you just kind of jump on, right? That's not the way strategy 4 works. It identifies momentum oftentimes when either it looks like there's no momentum at all or it's going in the opposite direction. All right. That's the beauty of strategy number 4. I'll show you some examples in just a few minutes. And you can apply it to any market in any time frame. So this is really a great method. The first method I ever learned, I continue to use to this day. Now, let me give you 2 of the rules. In fact, you actually already know one of the rules, which is the price being above the 50. If price is above the 50-period simple moving average, the overall trend is up. That means we're only going to look and identify and trade buy signals. Conversely, if price is below the 50-period simple moving average, the overall trend is down. That means we're only going to look to identify, trade, sell signals. Or if we want to, we can just avoid that market if we don't like to go short. That's rule number 1 of strategy number 4. There are 4 rules, and I'm giving you 2 of them. The second rule is this. When a bar closes in the top 25% of its range, so in other words, if you have a range of 4 points, okay, the low being, let's say, 50 and the high being 54. If it closes anywhere from 53 to 54, that top 25%, the market is saying, not some guy on TV or not some guy in a webinar, the market is telling you, I want to go higher on the short term. This is a fantastic edge to have because along with price being above the 50, if you also have this in place, you actually have the short term and the overall trend in sync. There's no reason to look at 2 different time frames, 2 different charts. It's right there. Okay. Now, conversely, when a bar is below the 50-period moving average and it closes in the bottom 25% of its range, the market, not me, not some economic report, the market is saying, I want to go lower on the short term. So what a great edge to have. Now, let me show you these 2 rules in action with some recent strategy number 4 examples, okay? All right, here's an example that happened just a few weeks ago, and this was in ADSK. Now, the stock was going up, but then had a free fall coming straight down. Most traders would say to themselves, well, the trend is down. Okay, the momentum is down. Most likely strategy number 4 generated a sell signal, right? Well, what's the first thing we do though? Rule number 1, apply the 50-period moving average. Where's price? Is it below the 50-period moving average? Absolutely not. It's above. So even though we've been selling off, These are buying opportunities. Now, where's rule number 2? Do you see any bars that close in the top 25%? Well, this one did right here. It closed near the high of its range. And so did this one. But guess what? Only this one met the remaining 2 rules of strategy number 4. So this is a valid buy signal. So in the first week of January, just about 3 weeks ago, a buy signal was generated. And guess what? Coming into last week, the stock was up 20 points higher. See how simple that was? Because this pattern was generated. You just learned 2 of the rules, and the remaining 2 rules were fulfilled. Let's look at another example in Charter, okay? Once again, about 3 weeks ago, hey, this stock is going higher. We should buy this, right? That guy in that trading room said it's going higher, making higher highs. Let's go long. Well, are we on the right side of the market? Rule number 1, apply the 50-period moving average. Nope. Price is below. Sure, it has been rising, but this is a selling opportunity. So if you were long, you could use this opportunity to exit. And if you're a more aggressive trader, you could look for rule number 2 to go short. Now, rule number 2 looks for bars that close in the bottom 25% of their range. And guess what? Both of these bars did. Now, just because you see these first 2 rules does not mean that these are valid sell signals. You still have 2 more rules in the pattern that need to be met, and the requirements need to be valid. But the good news is they both were. So they were both valid sell signals. And coming into January, you could have actually potentially captured 35 points up until just last week. Here's an example in PANW. All right, same thing. We're above the 50-period moving average, even though price has been declining. We close in the top 25%. The remaining 2 rules of strategy 4 have been met. So this is a valid strategy 4 signal. 50 points coming into last week that potentially you could have captured. Let's look at NXPI. Price is below the 50-period moving average. Even though it looks as if there's no momentum going anywhere, it's just kind of going sideways. Here is a valid sell signal. We had 2 closes above, but there were no buy signals generated. And finally, we went back down below, closed in the bottom 25%. A valid sell signal was generated and 25 points, okay? Now, we can apply this to other time frames. Here's a weekly chart of Costco. This was coming into last November, last year. Now, is there any momentum here? Actually, looking back the last 4 or 5 months, we're just kind of going sideways. But this is the beauty of strategy number 4. It can identify momentum even before it's visualized. For example, this buy signal was here right in the beginning of November, and coming into this month, you could have potentially captured 125 points. This can work to the downside as well. We have a weekly sell signal in ILMN, 2 sell signals actually, and the stock fell 90 points coming into the end of the year. If we have any currency pair traders here, here's a 4-hour chart of the dollar yen. This just happened last week, okay? The price is going down in the dollar yen, but we have price above the 50-period moving average, and we close in the top 25% here and here. So these are 2 valid strategy number 4 buy signals because the other 2 requirements were met. And we see we have a 350 pip gain coming into last week. This is on a 4-hour chart. If we look at the Swiss franc on a daily chart, once again, looks like the momentum is slowly going higher, right? But we're below the 50-period moving average. So this is a selling opportunity. We don't want to go long. And we close in the bottom 25% of this currency pair right here. So a valid sell signal was ultimately generated, and this was a nearly 380 pip gain if you had held on to this for the next 2-3 weeks. Okay, let's review what you learned today. The 4 steps to trading consistency are revealed in 4 questions that you must ask yourself, but you have to ask yourself these 4 questions prior to every trade. You can't be in a trade and then say, okay, well, I'm long this, gosh, I'm losing money. What are those 4 questions I'm supposed to ask? What are these 4 steps that we're required to have for consistency? You know, that's like trying to learn how to row a boat when you're going over the falls. You know, that's not the time to learn how to determine how to row your boat. What you have to do is learn these 4 questions like the back of your hand and ask yourself them with rapidity before you enter into any trade. And remember, the first one is, am I on the right side of the market? Now, most traders always think they're on the right side of the market, right? Therefore, you wouldn't take the trade if you didn't think it was going to work out. But that's why most traders fail, because you're really not on the right side of the market. The simplest way to do that is to ask yourself this question: where is my price of whatever I'm trading in relation to the 50-period moving average? Just plot a 50-period moving average and ask yourself that. Where is price in relation? If price is above, that means the overall trend is up. That means you should only be a buyer. That's how you be on the right side of the market. Conversely, if price is below, the market is telling you the overall trend is down, and that means you'll only be on the right side of the market if you're a seller. Next question is, where do I place my initial stop? There are tons of different ways to ask that, but we think the best way is to just simply go back and look at the last short-term low or the last short-term high. That's actually a very generic way to determine. But once you determine that, that will help you determine the next question: where's my profit target? All you want to do is determine if you were in the trade and you lost, if you got stopped out at your stop placement, well, how many points would you lose? Okay. Now, what you do is you double that amount of points. So if you lost 10 points, well, then you double that, which is obviously 20, and you want to exit with a 20-point gain. If you're going short, you want to place your exit 20 points lower. If you're going long, place it 20 points higher. This way, you'll have a good risk-reward ratio where you'll always make at least twice what you're risking. And then lastly, how do you protect your profit? Once you're in the trade, the worst feeling in the world is to have a profit on paper and then have that profit slowly sink into a loss, okay? So what you want to do is use the 50% rule. When you get half the distance, close or to the distance of the exit point, what you want to do is move your stop to unchanged. This is what we call playing with the house money. In other words, you're not risking anything. If price goes the opposite direction of where you want it to go, at least you won't lose anything. You'll just break even, okay? And then lastly, all of these four components are incorporated within strategy number 4. This is a strategy I learned some 4 decades ago. I continue to use today. It's probably one of our most popular methods we teach at Specialist Trading. We have students trading strategy 4 around the world in over 115 countries and in every state in the United States. Remember, just like my mentors taught me some 47 years ago, trading is really simple. It's the trader who makes it more difficult than it has to be. So if you're getting in your own way, if things are just too complicated, you're not seeing the type of results you really want, simplify your trading. Just apply these 4 different steps to your trading. It doesn't have to be strategy 4. It could be something else you're using. If you want to, we're going to show you a great way to acquire strategy 4 here with a great discount, but it doesn't have to be. You can apply it to whatever method you're using right now. Could be someone else's, could be one of the things that you've devised yourself. Makes no difference. We truly feel you will increase your odds for consistency if you apply these simple and very basic steps to consistency. Now, we have a great discount we're going to talk to you about today. And by great, I really mean great. I think you're going to be saving roughly $2,300. This is our strategy number 4 special. If you would like to become a member of our strategy number 4 course and learn the strategy that I first learned some 4 decades ago and continue to use, this is a great, great offer. This works on all markets and all time frames. As we just saw, you're going to get instant course access, detailed instruction. Remember, I told you each one of our courses comes with upwards of 6 or 7 different entries, 6 or 7 different exit placements, and 6 or 7 different stop placements. You're going to learn all of these because our philosophy is to provide you with this so you can decide for yourself, because we know not everyone trades the same way, and nor should you. Everyone comes in with different risk parameters. Everyone comes in with different capital requirements. So someone may like to trade and stay in the trade for a long time because that's just the way they like to trade. They're more of a longer term trader or investor. Whereas someone else may say, no, I want to get in and out in the shortest amount possible. I want to move on to the next trade. Or someone else may say, listen, I have a big account. I can take big risk. Someone else may say, no, I can't sleep at night when I know I'm risking a lot. I want the minimal risk. So we offer you all these different and provide you all these different options for trading so that you can make your own decision. Remember, it's been my experience that the only traders that are still around since my days of trading on the floor are the ones that make their own trading decisions. So this is what we're trying to instill in all of you as well. Now, we're going to throw in an extra bonus on top of this. Everything you saw today was displayed coming from our platform, the PTS Primo charting platform. We're going to throw in a full year of the PTS platform included, absolutely free. You're going to get this a full year. That's close to a $2,000 value. This is the trading educational platform I developed and designed with Pro Trader Strategies to actually make trading simple, to make it easy for you to trade and to teach you how to trade. Everything you saw, everything from the 50-period moving average line to the exit points to stop placement is one click away on the platform. It's very simple, and in a matter of seconds, you'll know where all these levels are, even the 50% rule as well. Okay, so we're going to also include that. All right, so let's break it down. Strategy number 4 included with the one full year of the platform. Now, normally, strategy number 4 costs close to $700, $695, okay? We're going to slash that by 50%. We're going to only charge you $347.50. Now, we're also including a full year of the platform, which is close to $2,000, and that's absolutely free. So you're saving roughly about $2,300. All that you have to come down with is $347.50. That's an amazing offer for, as I said, one of our most popular courses to date, something I trade each and every day. And if you're still not convinced, let me just show you what happened last week. This was a week ago today, all right? This is TXN, all right? This happened on the 17th in Texas Instruments. We are above the 50, okay? We close in the top 25%. Now, most traders would say, but yeah, Steve, it's been coming down every day. That guy in the trading room says, look, it closes down every day. This thing's going to fall out of bed. Remember, the reason why most traders fail is you overcomplicate things, and plus you listen to outside sources. Just focus on the one thing, which is the chart in front of you. It's telling you it wants to go higher on the overall trend, the 50-period moving average, and the short-term trend. Now, the remaining 2 rules of strategy number 4 were met. So all the rules are in place. You could have taken this and in just a matter of days, potentially captured upwards of 12 points, okay? Not a bad little quick trade. This just happened last Wednesday, a week ago from today. So these signals are happening all the time. And guess what? With our platform, you can actually scan for these setups as well. A year from today, you will have wished you became a member of the strategy number 4 course. So don't waste any more time. Invest in yourself. Take advantage of this greatly discounted offer of $347.50. Contact Pro Trader Strategies. They developed the platform with me. They're also in charge of all the course discounts and pricing. I would highly suggest giving them a call at 310-598-6677. They have trading consultants manning the phones right now. They'd be more than happy to take your order over the phone or answer any question you may have about the platform or about data or just about using it or strategy number 4 or any other methods that we may have deeply discounted. Now, that link you see at the bottom is the link that will take you to the info page. You can also sign up online if you'd like. It's not a live link, but a live link has just been posted in the webinar chat. So if you click on the chat box, the chat icon under that list there with the Zoom list, you can click that on and you'll see that live link there, okay? I promised you I would answer any questions you have. So if anyone has any questions concerning what I just taught today, please feel free to ask, and I will answer it to the best of my ability. Someone is asking, can this be used on other markets? Sure, yes. Strategy 4 can be applied to any market in any time frame. That's the beauty of it. It transfers over onto so many different markets. And I've always hated, when I've gone to seminars or classes before that I attended, where someone says, this is a great strategy. It never fails. It has a 90% win rate, but you can only trade it on a 15-minute time frame, and it has to be in this stock, and it has to be at this time of the day. And you say to yourself, there's too many restrictions. I mean, why can't I trade it on anything? Because in my opinion, a great strategy is one that can transfer onto any market at any time frame. So that's the beauty of strategy 4. Whether you're a crypto trader, whether you're a swing trader that trades currency pairs, whether you're a long-term investor that trades stocks, or whether you're an intraday E-mini future trader like myself, strategy number 4 can be applied to all those markets and all those time frames, okay? What is the price after the year of the platform? Well, remember, a full year initially starts, if you're not a student and you've never been a course member in any of our products or classes, it runs close to 2,000 on the platform. But guess what? Since you were a student of the strategy number 4 and had that platform for a year, I'm sure that Pro Trader Strategies would offer you some kind of discounted deal because you are a qualified, honored member now. So it wouldn't be close to 2,000, but it would be something you could ask them. I'm sure they would give you a great offer on another year or even 3 to 5 year package as well. Okay. Most of our students that have taken a year offer in the platform continue on and on. And they don't have to pay the full price because they've been a student for a while. They purchased a product to apply on the platform, so they get a discounted price when they want to re-up. So don't worry. This is something Pro Trader Strategies can answer. Okay. Any other questions? Yes, I continued to use Strategy 4. My signals today were actually 2 buy signals in Strategy 4. I had someone's asking me, I trade E-mini futures, so I know a lot of people don't trade that, but that's kind of my market of choice because it kind of gears back to my trading on the floor, very quick in and out trading. But remember, even if you trade weekly bars, if you trade monthly bars of a stock or a future, it makes no difference. Strategy 4 will generate signals, okay? Okay, no more questions. Now remember, if you do have any questions or if you're committed and you say, listen, I want to take advantage of this, I would highly recommend doing it right now because next week, most likely this offer is going to be over. Pro Trader Strategies will start a brand new offer. I'll give a new webinar. And this offer will go back to close to $2,300 because, or actually $2,600, I'm sorry, because the Strategy 4 course is $695 and then included with the platform. So you'd be trading, Strategy 4 with the platform for $2,700 a week from now. So for the low price of $347.50, I think you really can't beat that, okay? I'm sure many of you have lost more than that in the last couple of weeks. This is a great way to get your trading back on track. So really, call Pro Trader Strategies at 310-598-6677. There's absolutely no obligation. They would be happy to answer any question you may have. And if you're still thinking about it, remember, you make a decision before next week because most likely this offer will go by the wayside, okay? All right, as we conclude and take one last look at our disclaimer, I just want to thank you so much for attending today. Thank you for listening to 4 Steps to Consistency. This was a great educational presentation, so I hope you learned something. But most especially, I look forward to trading alongside with you strategy number 4. Thank you so much. Have a great trading day, and I shall see you next time. Bye-bye.